Hi, let's talk about FHA loans as a type of mortgage financing.
I've been loving you. I've been loving you. Oh, you know I do. Sweet lover of mine. Yeah, you're good for me. You're so damn good for me. You make my heart believe. Sweet lover of mine. When the sun comes up, my arms are holding you tight. When the moon is high, I sing this lullaby.
FHA. An alternative to a conventional mortgage is a FHA mortgage insured by the government through the Federal Housing Administration. FHA mortgages are made by FHA approved lenders. FHA insures mortgages on single-family and multifamily homes, including manufactured homes and hospitals. It is the largest insurer of mortgages in the world. The purpose of the FHA program is to make homeownership more accessible for consumers. The Federal Housing Administration is part of the United States Department of Housing and Urban Development. The government recognized that buyers didn't always have enough down payment available, even with PMI, making it possible to put less than 20% down. As a result, the government created an opportunity for non-conventional loans through an FHA insured loan. When the Federal Housing Administration was created in 1934, the housing industry was struggling. 2 million construction workers had lost their jobs. Terms were difficult to meet for homebuyers seeking mortgages. Mortgage loan terms were limited to 50% of the property's market value. 50%. That would mean 50% down. Repayment of the mortgage was spread over 3 to 5 years and ended with an unruly balloon payment. America was primarily a nation of renters. Only 4 in 10 households were owner-occupied homes. That means 6 out of 10 were renting. In the many years since the FHA was created, much has changed, and Americans are now arguably the best housed people in the world. HUD has helped greatly with that success. Characteristic of FHA mortgage loans: loan insurance. The Federal Housing Administration does not actually make loans. Instead, FHA insures the mortgages, protecting the lender from losses should the homeowner default. Risk is lowered for the lender. FHA loans must meet qualifying standards. Lending source. FHA mortgage loans are made by lenders in the primary market. The Federal Housing Administration does not lend money, nor do they buy the loans. The loans come from FHA-approved lenders and mortgage brokers. Discount points. Lenders providing an FHA loan may charge discount points. These discount points may be paid by either the buyer or the seller. Amount of down payment. A down payment of at least 3.5% of the purchase price is required to secure an FHA loan. If a borrower does not have this amount of money as a down payment, it may come from a relative with an approved gift letter. Sellers may not provide the down payment. Loan limit. FHA loans are in place to provide housing for the average earning family. Therefore, FHA loan limits dictate the maximum purchase price a home may be to qualify under a FHA mortgage. However, as cost of housing varies across the country, the loan maximum also varies. Insured commitment. Due to the popularity of FHA mortgages, developers often seek a commitment from FHA that FHA loans will be available for the homes even before the development is finished. The homes must be built to FHA standards to receive the commitment. FHA cost to borrower. The cost of the FHA loan, which acts as an insurance policy to lenders, are passed on to the borrower in two ways: upfront mortgage insurance premium, UFMIP, and mortgage insurance premium, MIP. Upfront mortgage insurance premium, UFMIP. Upfront mortgage insurance premium is a fee charged to borrowers at closing to cover the cost of insuring the FHA loan. The money goes into a fund in case the borrower defaults, and the fee charged can vary based on whether on a new or resale of a home and on the term of the loan. Mortgage insurance premiums, MIP. Mortgage insurance premium payments are also added to each monthly payment to offset the cost of the FHA loan program. It goes into a fund in case the borrower defaults and increases the total loan payment, so must be used in calculating qualifying ratios. Qualifying ratios. Borrowers of a FHA loan must meet debt-to-income standards. The same TOR standard is used as with a conventional mortgage. However, for a FHA loan, the borrower may have as high as a 43% ratio. Remember that only 36% is allowed for a conventional mortgage approval. Although the TOR measurement is more relaxed, an additional qualifying standard has been added which measures the borrower's income to just their total housing expense. This is called the housing expense ratio, HER. The housing expense ratio, HER, which measures PITI plus MIP to income, cannot exceed 31%. Remember that PITI stands for principal, interest, taxes, and insurance. MIP is the mortgage insurance premium that's added to the monthly payment in an FHA loan. Housing expense ratio, HER. To calculate the housing expense ratio, you use this formula. You take the monthly housing expenses, which includes PITI and MIP, and you divide it by the monthly gross income. This equals the housing expense ratio. What FHA is doing is acknowledging that just because someone doesn't have additional loans, such as a car payment, at the time of purchasing the home, doesn't mean that room shouldn't be left in the budget for those types of loans in the future. The FHA HER requirement attempts to prevent a borrower from becoming house poor by having too much of their income being used up by housing expense. Story problem. Kent wants to buy a home utilizing a FHA loan. The total PITI and MIP on the home that he wants to buy will be $625. He's already paying $800 in other long-term debt obligations. He has a car payment of $525 and a total credit card debt of $275. Kent's gross monthly income is $3,200. Will he qualify for this home utilizing a FHA loan? Remember, to qualify for a FHA loan, you have to meet both TOR and HER qualifying ratio standards. So let's start by calculating the housing expense ratio. To do that, you take your monthly housing expenses, your PITI and your MIP added together, and you divide by the monthly gross income to equal the housing expense ratio. So in this case, we have a housing payment of $625, which we divide by $3,200. This equals 0.20, or 20% HER, which is below the housing expense parameter. So based on HER, the home would qualify for an FHA loan, but we also still have to check the TOR standard. So when calculating TOR, we take the total monthly obligations of all debt and we divide by the monthly gross income. So let's calculate the total monthly obligations in this situation. We have the $800 house payment, which includes PITI as well as the monthly insurance premium, and we add to that the $625 in other long-term debt. This means that our buyer has $1,425 in debt that we then have to divide by the monthly gross income. So we take the $1,425 and we divide by $3,200, which equals 0.45 or 45%. So our TOR ratio is 45%. So although the buyer did qualify under the HER standard, being below 31% in the housing expense ratio, the amount of other long-term debt now means that the buyer does not qualify for the FHA loan because they have a debt total obligation ratio of 45%, whereas it needed to be below the 43% to meet the FHA standards. Qualifying ratios, loan comparison. With so many different qualifying ratios based on the type of loan that's being sought, it's nice to look at it in kind of a column by column manner so that you can compare one type of loan to the other. So in our first column here, we do have our type of loan. In our second column, we have our housing expense ratio, and in our third column, we have our total expense ratio. So for conventional loans, remember that there is no housing expense ratio. Instead, you're only worried about the total obligation ratio. The FHA loan, on the other hand, has a mandatory 31% HER ratio or below and a total obligation ratio for debt at 43% or below. The VA loan, just like the conventional loan, does not have a housing expense ratio requirement and instead allows for up to 41% in the total obligation ratio. Interest rate. Although insured by the government, FHA loan interest rates are not dictated by the government. Interest rates are negotiated in the free-flowing and open money market between borrower and lender. Appraisal. Properties purchased with an FHA loan must pass an FHA-specific appraisal. The property will be appraised and inspected by a HUD-approved home appraiser. This individual will determine the current market value of the property and will also inspect it to ensure it meets HUD's minimum property standards. Closing cost. To prevent borrowers from being taken advantage of by lenders, FHA defines allowable closing costs. Allowable costs include the appraisal fee and any inspection fees, actual cost of credit reports, lender's origination fee, deposit verification fees, home inspection service fees up to $200, cost of title examination and title insurance, document preparation fees, documents that are by a third party and not controlled by the lender, property survey fees, attorney fees, recording fees, transfer stamps and taxes, test and certification fees, water test, etc. Sellers are allowed to pay up to 6% of the sales price towards the buyer's closing cost. This is not required, but is often negotiated between buyers and sellers. Down payment is not a closing cost. Assumption. FHA loans do not have a due on sale clause. As such, FHA loans are assumable. A buyer of a home with an existing FHA loan can assume the existing mortgage if the new buyer qualifies and is approved by the existing lender. This provision is not open to investors as you must agree to be owner-occupied. Prepayment clause. FHA loans include a prepayment clause. FHA loans do not include a prepayment penalty clause. Therefore, loans may be paid off early without penalty. The prepayment clause allows the borrower to pay off the loan at any point. The absence of the prepayment penalty clause means that the borrower is not penalized by being charged a fee when paying the loan off early. Points in summary about FHA mortgages. Government insured mortgage, loans made by approved lenders, requires 3.5% down. There are loan maximums. These loans can be assumed by new borrowers. Upfront mortgage insurance is charged, along with the monthly mortgage insurance. Interest rates are negotiable, allowed up to 31% as the HER qualifying requirement, and up to 43% of the TOR qualifying requirement.